traders. Today we embark on a storytelling journey through the fascinating world of continuation candlestick patterns. This captivating narrative unfolds in the realm of financial markets, where subtle signs and signals can herald significant shifts in market trends. Our protagonists for this chapter are intriguing characters you're about to meet. Doji, spinning top, falling 3 methods, rising 3 methods, upside Tasuki gap, downside Tasuki gap, mat hold, rising window, falling window, and high wave. Each character represents a unique pattern that provides insights into the ongoing market trends, and understanding these characters can equip you with valuable tools to navigate the tumultuous seas of trading. From the mysterious Doji, signaling market indecision, to the assertive falling window, driving the market down, each character has a story to tell, a secret to reveal. So brace yourselves for an insightful journey. Let's dive in and get to know these characters better. Let's meet our first character, the Doji. Picture a cross on your chart. That's a Doji. The opening and closing prices are almost identical, creating this unique symbol. But what does our Doji friend signify? Well, it's like a tug of war between buyers and sellers, a sign of market indecision. Neither side has won the battle, hence the almost equal opening and closing prices. Now, how do we use this in our trading journey? It's quite simple. When you spot a Doji after a trend, whether it's an uptrend or downtrend, take note. This could suggest a potential reversal. The market might be about to change direction. But remember, it's merely a suggestion. It's crucial to consider other indicators and factors before making your move. So keep your eyes peeled for this little cross on your chart. Remember, when Doji appears after a trend, it suggests a potential reversal. Next, we come across the spinning top. A spinning top is an interesting character in our tale. Imagine a small body with long upper and lower wicks, like a child's spinning top toy. This spinning top, however, represents a market whirling in indecision. It dances on the chart, signifying a delicate balance between the bulls and bears. Neither side has gained the upper hand, resulting in a small body with long shadows. Now, you might ask, how does this help me? Well, the spinning top is a beacon that guides us during a trend reversal. It's like a lighthouse in the foggy market, signaling a possible shift in sentiment. When you spot a spinning top, it's time to pay close attention. The market might be preparing to change its course. So keep your eyes peeled for this little spinning toy on your chart. Look for spinning tops during a trend reversal, indicating a possible shift in sentiment. Now, let's uncover the falling 3 methods. This pattern is like a sandwich of market sentiment, where the bread slices are bearish and the filling is a little bullish interruption. The pattern begins with a long bearish candle, followed by 3 smaller bullish candles, and concludes with another long bearish candle. It's like the bears are taking a short break before they resume their control over the market. This pattern signifies that despite the bulls trying to push the market upwards, the bears are maintaining their dominance. The brief pause by the bulls is just that, brief. The bears quickly regain control and push the market downwards again. So how do you use this pattern? When you spot the falling 3 methods, brace yourself for the downtrend to continue. This pattern is a clear indicator that the bears are not done yet. They're just catching their breath before they exert their influence again. Expect the downtrend to resume after this brief bullish pause. Moving on, we'll investigate the rising 3 methods. This bullish continuation pattern is like a short story of market resilience. Picture this: 3 small bearish candles, each closing within the previous day's range, nestled between 2 long bullish candles. That's your rising 3 methods. These 3 bearish candles are like a brief pause in a conversation, a momentary interruption in an otherwise bullish chatter. But what does this signify? It shows that the bulls, despite a brief bearish interruption, are firmly holding their ground. They're not swayed by the bearish whispers, indicating their strength and resolve. And how do we use this pattern? Well, the rising three methods serve as a signpost, pointing to the continuation of an uptrend. When you spot this pattern, it's like a green light to anticipate that the uptrend will resume, driving the market further up. So, hold on to your bullish positions and anticipate the uptrend to continue after a temporary bearish setback. Let's discover the upside Tasuki gap, downside Tasuki gap, and mat hold. Our journey takes us first to the upside Tasuki gap. Imagine spotting a bullish gap on your chart, followed by a bearish candle, then another bullish gap. This is your sign of upward momentum. The bulls are charging ahead, maintaining control. So when you see an upside Tasuki gap, you can expect the upward trend to persist with strength. Next, we traverse to the downside Tasuki gap. Picture a bearish gap, followed by a bullish candle, then another bearish gap. This visual cue signals downward momentum. The bears are dominating, keeping the downward pressure. When you come across a downside Tasuki gap, anticipate the continuation of the downward trend. Lastly, we arrive at the mat hold. This is a series of candles with a common opening or closing price. It's a strong continuation pattern that tells you a powerful trend is in play and the market is holding its ground. When the mat hold appears on your chart, trust the trend. This pattern indicates that momentum is sustained. Now, how do we use these patterns in our trading decisions? The upside Tasuki gap is a bullish signal. When you spot this pattern, consider buying as the upward trend is likely to continue. The downside Tasuki gap, on the other hand, is a bearish signal. If you see this pattern, it might be time to sell or short, as the downward trend is expected to persist. And what about the mat hold? This pattern is all about momentum. It doesn't matter whether the trend is bullish or bearish. What's important is that a strong trend is in place. So when a mat hold appears on your chart, go with the flow of the trend. It's likely to continue. These patterns are all about momentum. So trust the trend when you see one. Finally, we'll analyze the rising window, falling window, and high wave. Let's start with the rising window. It's like a breath of fresh air for bulls. Spotting this is like seeing a bullish gap on your chart, where the opening price is higher than the previous closing price. What does this mean? Well, it's a clear sign that bulls are eager, pushing the market upwards. When you see a rising window, expect the bullish trend to continue with vigor, moving on to its counterpart, the falling window. This is a bearish gap on the chart, where the opening price is lower than the previous closing price. This pattern signifies that bears are assertive, driving the market down. When you encounter a falling window, it's a cue to anticipate the continuation of the bearish trend. Finally, let's talk about the high wave. This pattern looks like a small real body with long upper and lower shadows. It's a visible depiction of market indecision. Think of it as a battlefield where bulls and bears are locked in combat, but no clear winner emerges. When you see a high wave, it's a signal to exercise caution as the market is undecided. In conclusion, these patterns, the rising window, the falling window, and the high wave, are powerful tools in your trading arsenal. They help to analyze market trends and anticipate potential shifts. But remember, while these patterns can provide valuable clues, they are not infallible. Always use them in conjunction with other technical analysis tools to validate your trading decisions. Remember, these patterns signal a clear momentum direction or market indecision. We've met some interesting characters today, each with their unique story. The Doji, a symbol of market indecision, and the spinning top, a sign of shifting sentiment. We've explored the falling and rising three methods, signifying the bears and bulls holding their ground. We've discovered the upside and downside Tasuki gap, indicating upward and downward momentum. We've unraveled the mat hold pattern, a strong signal of a prevailing trend. We've analyzed the rising and falling window, reflecting the eagerness of the bulls and the assertiveness of the bears. And lastly, the high wave, a warning sign of market indecision. Each of these continuation candlestick patterns tells a tale of market dynamics, a narrative of bullish and bearish forces. They provide us with invaluable insights into the direction and strength of market trends.